Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, we have Gragnani. He's the head of research and client engagement at Nasdaq Dorsey Wright with his monthly update. They're taking a look at the charts. Jay, it's great to have you with me as always. It's been quite an interesting month since we spoke last time. Volatility is definitely back into the market.
That it is. And really, the volatility has been back in the market for the past couple of months. You know, it's interesting when you look out today and you look at the S&P 500, most major market indexes, Nasdaq 100, whatever it is, and they're all up nicely, all up double digits, 16, 17, 18%. But when you go and look at it, all of that gain came in the first 4 months of this year. That first 4 months of the year produced a return for the S&P 500 of 17%, and basically since May 1st, that number is flat. However, there's been a lot of volatility underneath the surface. If you go back since May 1st, we've seen 5 different moves of 5% or more, either up or down. 3 of those have been 5% moves down, and 2 of those have been 5% moves up. And so you've certainly seen a lot of volatility, not just last month, but really over the past 5 months. And that's really what investors are feeling today, is that volatility that has come into the markets here recently over the past few months.
That's an excellent point. Let's pull up the first chart you have for us. This is the S&P 500. This is the point and click chart, correct?
Yes, point and figure chart for the S&P 500. And again, the point and figure chart consists very simply of X's and O's. X's represent prices are rising, O's represent that prices are falling, and you can see that volatility that we've seen this year. You can see the S&P 500 chart back here at 2950 on the 1st of May, peaking, and it's been a roller coaster ever since. You've seen an initial 7% move lower in May and June, then a subsequent 10% rally higher to hit new highs, and then a couple more pullbacks of 5% or more. What we're paying attention to right now is on the right-hand side of that chart, that red dotted line that's going up the chart is what we call a bullish support line. It represents being in a positive trend. And when you saw here recently, the pullback that happened in the market to 2860 for the S&P 500, pulled back right to support and has initially bounced off that support level and held its positive trend line for the time being. Market's pulling back a bit today, but still not in danger of violating that positive trend.
All right. What do the small caps look like? On our next chart here, are they telling you the same story that you're seeing in the S&P? Yeah,
the small caps look very, very different than the large caps, and on a lot of different levels. One metric is just looking at the peak to trough move. If you think what we just talked about on the S&P 500 is, call it within 5% of its all-time highs. The SML 600, the IJR ETF, which is a basket of small cap stocks, it's almost 17% off its high from last year, was not able to eclipse new high earlier this year. And that in and of itself is a negative divergence for small caps. You're seeing a lot of those small caps just not able to keep up with the market. If you think that the S&P, the Nasdaq 100 all up 17, 18% on a year-to-date basis, the average small cap stock is just up about 9% on a year-to-date basis. So really lagging. What you're also seeing is while the general trend in absolute terms is positive, the small cap index, the IJR, is facing quite a bit of overhead resistance right there on the chart at $81. And 4 different times now, this chart going back to November of last year has rallied to $81, did so again in February, did so again in May of this year, and then again in September, but not able to get through that level of resistance. So that's going to be a key sign going forward for small caps in general. Are they able to actually get through and see some moves higher through that area of resistance? But right now, when we look at just the difference, it's really the large caps that are carrying the market as opposed to the small caps underneath the surface.
That's why I like these point and figure charts. It makes it very digestible and easy to understand where these levels are. Let's move on to October returns. We can isolate some more near-term performance here.
So October is always this month that has investors have a love-hate relationship with. It's often the last month in what we know is the seasonally weak period in the market, that stretch that runs from May through October. What that also means is we tend to see generally good buying opportunities coming out of the month of October, but you also have seen some very historic moves lower in the month of October. Think back to the crash of '87 happened in October. You think 2008 in October the market was down 17%. Even last year down 7%. So you can get some volatile moves during the month of October. That's not uncommon, but on the surface, on the whole, when you look at last October, the market being down 7% that you can see on the right-hand side there, was just the 5th time that October was down 5% or more for the S&P 500 in the month of October. And only once has that ever happened back to back. You have to go all the way back to 78 and 79 to see that happen. And so when you look at the returns on average, October tends to be a positive month, producing a better batting average for positive returns than negative returns. But certainly it would suggest, when you look at the market, you look at the S&P charts and everything that's going on right now, is it wouldn't be a surprise to continue to see some more volatility as we head in through the end of October before we pick up into November.
All right, that's it for our charts, but I want to get your thoughts on growth versus value, because there's been a narrative in financial media that it's rotating into value at this point. Would you agree?
Not exactly. You know, when we look at the market, all I can do is base it on the numbers. When you go back and you look, whether it's just pure performance, I would agree over the past month that value has done better. But really outside of that, when you go back and you look 6 months, 9 months, 12 months, 3 years, 5 years, growth continues to be the dominant theme. And so you think sectors like technology, very growth oriented. Indexes like the Nasdaq 100, very growth oriented. Those are the areas of the market that continue to lead, not only from a pure performance standpoint, but also from a relative strength ranking perspective. When we look at our scores, because we score all of the different styles, large cap growth and small cap value, the small caps continue to run down at the bottom in terms of their ranking, while large cap, and specifically large cap growth, continues to run at the top. So while we've seen some near-term outperformance, i.e. 1 month of value, it's just not 1 month does not make a trend, and it's not there yet to suggest that growth is ready to give up the baton just yet.
All right, that's exactly what your charts were showing before. We look forward to having you back in November. We'll see how October plays out. I'm sure it'll be an interesting month. Thank you so much, Jay, as always. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.